Hi, everyone. I'm Caroline Zakarian, and I work in the Office of Signals and Community Services here at the Los Angeles Public Library. Welcome to National Homeownership Month. Today's presentation is called Buying a Home, and it's brought to you by the Los Angeles Alliance for Economic Inclusion and the Los Angeles Public Library. Today, Mary Duran, Cheryl Ryman, and Michael Bailey from AEI will go over the process involved in buying a home, including information on loans, mortgages, making an offer, and closing on a home. There will be a brief Q&A after the presentation, so please send us your questions throughout the program. Thank you, and take it away, Mary.
Thank you so much, Caroline. We're so pleased that the Los Angeles Public Library is hosting this workshop today, and my colleagues Cheryl Ryman and Michael Bailey look forward to presenting information related to buying a home. Next, I wanted to say, though, we have a disclaimer that this presentation represents the views of the speakers and not necessarily those of the agencies they represent. This presentation cannot be reproduced or distributed by a third party or on a third party website without prior authorization. Reference to any specific organization does not constitute an endorsement or a recommendation or a favoring by the FDIC or the United States government. So I wanted to share, and Caroline did a great job of actually sharing what we're going to talk to you today about. It's to provide you information about how to get ready to own a home, finance the purchase, and move forward with buying it. You're going to learn about the steps involved in buying a home, how to know if you're ready to buy one, estimating how much you can afford, talk about home financing options, some key costs, how to get pre-qualified and pre-approved and what the difference is, and how to compare loan estimates. The professionals who can help you and become a homeowner, the process of making an offer, negotiating with the seller, and closing the purchase. And after you purchase your home, if you should run into any financial trouble, making your payments, where can you seek assistance? I would like to now turn it over to Mike Bailey, who will begin the presentation on buying a home. Michael?
Thank you for joining us today. Again, my name is Mike Bailey, and I am with the Los Angeles Alliance for Economic Inclusion. We're excited to share information today from the FDIC Money Smart program on buying a home with you today. Section 1, we're going to talk about getting ready to own your own home. We'll discuss how to get ready and figure out what you can afford. Key takeaway in the home buying process is to make sure that you're ready to buy again and figure out what you can actually afford. So now, the steps to buying a home. Step 1, get ready. Decide if you're ready to buy a home. You can always reevaluate this decision later on in the process. Figure out how much you can afford. It will save you time and trouble down the road to have a good sense of what price range you want to focus on in your home search. Another important factor is to check your credit history. It is extremely important. Lenders use your credit history to determine whether they will lend you money so you can buy a home and how much the loan will cost you. In order to check your credit, you can go to www.annualcreditreport.com and review your credit reports for free. That website is the only place where you can get the free credit reports from the 3 nationwide credit reporting agencies then you're entitled to under the law every 12 months. So again, checking your own credit report does not affect your credit. Again, you can go to www.annualcreditreport.com to get a free copy of your reports. Step 2, figure out the financing. Learn about mortgages or other financing options. You want to make sure that you shop around so you can get the best deal from the best lender. Get pre-qualified or pre-approved. We'll talk about the differences between those two later in the presentation. Step 3, shop for your home. Put together your team. Identify and consult the professionals that can help you search for, finance, and purchase a home. Find a home that fits your needs and that you can afford. Step 4, buy your home. Make an offer on the home you find that meets your needs and that you can afford. negotiate with the seller. You want to make sure that you consider getting a home inspection. And finally, you will close. This completes the process of buying your home. It's when you become the homeowner. Step 5, maintain your home. You worked hard to get it, so protect your investment. While not discussed in this module, home maintenance helps keep your home at its value and reduces the risk of costly repairs later. A big question to answer when you want to buy a home is, how much can I afford? When it comes to what is affordable for you, only you can make that decision. However, you can use advice or guidelines to help you decide what may be affordable. We're going to talk about 2 different ways to estimate what you may be able to afford. The first is your spending and savings planning, figuring out what you have left for housing costs after you pay for everything else. And then secondly will be your debt to income ratio, figuring out how much of your income will go to covering your monthly debt payments. This includes the monthly payment for your home. A mortgage is a home loan. You pay back the loan with monthly mortgage payments. Your monthly mortgage payments are probably going to be the biggest part of your housing cost. When you buy a home, your monthly mortgage payment generally has 4 parts, commonly referred to as PITI. Principal, the amount of money you borrow, interest on the principal, taxes, real estate taxes, and insurance, homeowner's insurance. The debt to income ratio is another tool you can use to estimate whether you can afford to borrow the money you need to buy a home. Your debt to income ratio is a calculation. The formula for debt to income ratio is total monthly debt payments divided by monthly gross income. The debt to income ratio is often written as a percentage. It shows how much of your monthly gross income, that is, your income before taxes or other deductions are taken out, goes to covering your monthly debt payments. Your monthly debt payments include your payments on any credit card balances you may have, your payments on loans you may have, such as car loans or personal loans and student loans, and your anticipated monthly housing payment. When lenders look at your debt to income ratio, they have their own way of calculating it. For example, some lenders treat student loans differently from other loans. You can ask the lender how they will calculate the ratio. So if a debt to income ratio is 40%, that means 60% of your gross income is available to cover everything else. Different lenders set different limits for acceptable debt to income ratios. Some lenders prefer a debt to income ratio of 36% or less. Other lenders will accept up to 43%, depending on your credit score and other factors. You may even accept higher debt to income ratios. For most households, keeping their debt to income ratio lower than the higher provides more stability and security. And I'll say that again, for some households, keeping your debt to income ratio lower rather than higher provides more stability and security. The debt to income ratio shows how much of your gross income goes toward debt, but you still have other expenses. So now we'll look at an example of a debt to income ratio. In this example, the total monthly debt payments are $2,045. The monthly gross income, that is the total income that you receive for the month, is $3,750. If you divide the total monthly debt payments divided by the monthly gross income, you get 54.5%. So what does this tell us in this example? More than half of the income is covering debt. The individual may want to look at lowering housing costs or ways to reduce or eliminate other debt in order to bring down their debt to income ratio. Many lenders would not loan money to someone with a debt to income ratio this high. Remember, the average is about 36%. Different lenders and loan programs vary in how they use debt to income ratio and other information to determine whether they offer you a loan and on what terms. and lenders may treat student loan payments and other debts differently when they calculate a debt-to-income ratio. So based on this debt-to-income ratio, can this person afford a house? Probably not. The debt-to-income ratio is likely too high based on the preferences of most lenders. So how could this person lower their debt-to-income ratio? They could reduce other debt, select a less expensive house, make larger down payment, and borrow less money, which will reduce the monthly mortgage loan amount. They could ask a family member for help with the down payment, or also search and see if there's any federal, state, or community programs to help people with down payment assistance or closing costs. And lastly, they could increase their income, maybe ask for a raise or take on another job. Remember the key takeaway from this section. Buying a home is a process. Start by making sure you're ready to buy and figure out what you can afford. Section 2, financing a home purchase. In this section, we will identify types of loans, define loan terms and concepts, describe how mortgages work, and shop around for a mortgage. Our key takeaway here is know your loan. Learn about your financing options for buying a home and shop around to get the best deal for you. So a mortgage loan is a loan to buy your house, condominium, or townhouse. Principal is the amount of money you borrow. Some of the many costs associated with taking out a mortgage includes interest. Interest is the cost of using money borrowed expressed as a percentage. Points. Some lenders may offer you the option of paying points. You will pay more money up front, but you will receive lower interest rates and will likely pay less money over time. Points can be a good choice for people who know they will keep the loan for a long time. Fees. These can include lender charges for processing your application. They may have different names such as application fees, processing fees, and underwriting fees. And then other charges such as appraisal fees to determine the value of the property. Lenders will tell you the annual percentage rate, otherwise known as APR, for a mortgage you are considering. The APR represents the overall cost of the loan on an annual basis. The APR includes not only the interest rate, but also the points, some of the fees you are charged, and other charges that you have to pay to get the loan. For that reason, your APR is usually higher than your interest rate. APRs can also help you comparison shop for loans. The down payment is a portion of the purchase price of the home that you will pay in cash. For example, if you wanted to buy a home for $160,000 and paid $8,000 for a down payment, you will borrow or finance $152,000, which equates to about 5% down payment. Needless to say, the higher your down payment, the less money you have to borrow. When your down payment is less than 20% of the purchase price, lenders may require you to purchase private mortgage insurance. Private mortgage insurance is different from homeowners insurance. Homeowners insurance pays for losses and damage to your property if something unexpected happens, like a fire or burglary. PMI lowers the risk to the lender in a residential real estate transaction. PMI increases your monthly payments. The lower your down payment as it relates to the purchase price of the house, the more likely you will have to pay PMI. The terms of your loan will specify how long you must pay PMI. Some loans require you to pay PMI until a certain percentage of your loan is paid off, whereas others may specify a period of time or require it for the life of the loan. As we discussed several parts of a mortgage payment earlier, principal, interest, taxes, and insurance, or PITI, now let's talk about taxes and insurance. There are two common ways to pay for real estate or property taxes and homeowners insurance. Escrow as part of your monthly mortgage payment, or pay them yourself. Sometimes your lender may give you the choice of paying your taxes and insurance yourself or having an escrow account. More often, though, lenders will require an escrow account. This is not to be confused with the escrow process often involved in a real estate transaction between a buyer and a seller. This reference is specifically related to your lender holding your prepayment of funds for property taxes and insurance once escrow closes on the transaction. Even if you aren't required to use an escrow account, you may find it easier to do so. That way you don't have to worry about making payments when they come due. Your lender or mortgage servicer may add the amount to your monthly mortgage payment and deposit the monthly installments for taxes and insurance into a monthly escrow account. Then they use the funds in that escrow account to pay your tax and insurance bills when they come due, typically once or twice per year. Your property taxes and homeowners insurance premiums can change from year to year. Your escrow payment, and with it, your total monthly payment, will also then change. Mortgages. A fixed rate mortgage is one in which the interest rate does not change. You pay the same amount each month in principal and interest for the life of the loan. Even if interest rates rise, your payment doesn't change because your interest rate stays the same. That is, it is fixed. Don't forget though, even with a fixed rate mortgage, your monthly payment will likely increase if you have an escrow account for paying taxes and insurance premiums, and either or both of those increase. The term of a fixed rate mortgage is often 15 to 30 years, although there may be other term lengths available. This kind of mortgage may be a good choice if interest rates are low or you plan to keep the mortgage for a long time. Adjustable rate mortgages, or ARM loan. Your mortgage may start with a lower interest rate than fixed rate mortgages, but your interest rate and therefore your monthly payment will likely change. They could go up, sometimes by a lot. The rate adjusts on a predetermined date. For example, every year, or every 3 years, or every 5 years, or every 7 years, or because it is tied to an index. An index is a common standard interest rate. This is often expressed in numbers such as a 3-to-1 ARM, where the 3 stands for the number of years that the interest rate will stay the same, and the 1 means that the interest rate could change every year after the first 3 years. A 3-2 ARM, for example, means the interest rate stays the same for 3 years, and then it can change every 2 years. An ARM may be a good choice if you plan to keep the mortgage for a short time. An ARM may not be a good choice if you cannot afford to pay more if the interest rates do go up. If you are considering an adjustable rate mortgage, be sure to carefully review the Consumer Handbook on Adjustable Rate Mortgages. It's a brochure that the lender will give you at the time of closing. You can preview it by Googling Handbook on Adjustable Rate Mortgages. When you Google and you search results come up, you want to select the one that's from the Consumer Financial Protection Bureau or consumerfinance.gov. Conventional mortgages. Mortgages can be classified as either conventional or government guarantee, which is sometimes called government insured. Conventional mortgages do not have special requirements for borrowers, such as having served in the military or be living in a rural community. They are available to anyone, but they may be more difficult for some people to qualify for than other types of mortgages. You generally need a credit history that is considered good by lenders. As previously mentioned, your credit history plays an important role in the home buying process. If you're considering buying a home now or sometime in the future, you must review all 3 of your primary credit reports. So that's Experian, Equifax, and TransUnion. In addition to good credit history, also have a regular income, a debt-to-income ratio within the lender's acceptable limits. So remember, the traditional rule of thumb was 36%, but there are exceptions, and some lenders will approve loans for people with higher ratios. And lastly, a down payment, which may range from 3 to 20% or more, depending on the lender and loan program. I will now turn it over to my colleague to continue. Cheryl.
Well, thank you, Michael. So bear with me, everyone, as we move quickly through the rest of the presentation, since we have a lot of great information to share. So the government guaranteed loans include FHA loans, USDA loans, VA loans, and HUD loans. The U.S. Federal Housing Administration, FHA, helps people become homeowners. With an FHA loan, the lender may be able to offer you better terms than a conventional loan, including a down payment as low as 3.5% of the purchase price of the home. Closing costs may be included in the loan amount. They're financed into the loan amount so that you don't have to come up with the cash. It's not due as a lump sum at closing. In addition, they may also offer lower closing costs. FHA loans may be easier to qualify for, but there is a maximum loan amount, and that varies by region. You may have to pay PMI or MIP, mortgage insurance premium, similar to the private mortgage insurance PMI. And with MIP, you pay part of this cost upfront at closing and every month as part of your mortgage payment. Then the U.S. Department of Agriculture, USDA, also has some home loan guarantee programs similar to FHA. The big difference between those two, USDA and FHA, is that USDA loans only cover properties that are in designated rural areas. And then the VA, the U.S. Department of Veterans Affairs, has a home loan guarantee program. These loans are called VA loans, and this type of loan is only available to qualified members of the military. VA loans do not require a down payment, although you could choose to make one. They also do not have mortgage insurance requirements. Although there is an upfront funding fee, the amount of that fee varies based on type of military service, down payment, if any, disability status, whether you're buying a home or refinancing another mortgage, and whether this is your first VA loan or if you've had one before. In addition, HUD offers other specialty loan programs. Now we've got there's a number of programs that are available for down payment assistance and other types of assistance, which may be available from state and local government agencies. Home buying assistance programs may include down payment assistance or assistance with the closing costs. First-time homebuyer programs offer down payment assistance, specific loans that are cost-effective, and or other forms of assistance to people buying a home for the first time. And that doesn't mean the first time ever. Often these programs are designed if you have not been a homeowner in the past 3 or 5 years, and that depends on the specific loan programs. Programs also are available to help people in specific professions to get homes in the communities where they work. For example, HUD's Good Neighbor Next Door program offers homes at discounted prices for law enforcement officers, teachers, firefighters, and emergency care workers. In addition, there are often other programs available from state housing finance agencies, such as in California, we have the California Housing Finance Agency, also known as Cal FHA. And you can Google Cal FHA loans to get additional information on that. In addition, just to make note, sometimes nonprofit organizations host home ownership fairs, bringing together various organizations that offer assistance and support, especially for low and moderate income first-time home buyers. Now, the amount that you pay each month for your mortgage is amortized. And I have a hard time saying that, so bear with me, amortized. And that means the payment is calculated in a way to ensure that you pay a portion of both the principal and the interest each month. That also means that your payment will be the same each month, except when your interest rate changes if you have an adjustable rate mortgage. Now, the amortization schedule you receive from the lender will show you how much of each payment is going towards paying down the principal and how much of each of your payments is going to pay interest over the life of the loan. It is important to note, though, that early in the life of your loan, the majority of your payment amount will be applied to interest, not the principal. Although many loans allow prepayment of principal, if it is allowed, paying just a little extra each month towards the principal can result in significant savings over the life of the loan. For example, if your payment amount is $2,347, rounding your payment up to the next $100 to an even $2,400, or if you can push that to $2,500, it will save you over the life of the loan in your interest costs and allow you to pay that loan off sooner. And on the next slide, pre-qualification. Pre-qualification and pre-approval are two different things. Pre-qualification is an informal way to get an estimate of how much money you might be able to borrow. You can be pre-qualified by giving a lender some basic information over the phone. No paperwork is required. There is no obligation. The pre-qualified amount is not exact. It's only an estimate. Most importantly, remember that pre-qualification is not an approval for a loan. Now, pre-approval is a commitment from the lender to lend you money under certain circumstances which they specify. It really helps when you're shopping for a loan to get pre-approval, because then the sellers know you're ready to buy and your lender is ready to fund. So on the next slide, then, we'll talk about some of the documents that are required. So as I mentioned, pre-qualification is an informal way to get an estimate on how much money you might be able to borrow. You can be pre-qualified by giving the lender basic information, usually over the phone or over the internet, such as employment information, income information, down payment information, outstanding debts, and your Social Security number. Now, generally, there's no paperwork required. There's no obligation. Like I said, the pre-qualified amount is just an estimate. It is not a commitment for the lender to provide funding. Now, the pre-approval is a whole different ballgame. The pre-approval is a commitment. This is the lender has underwritten your loan. They've reviewed your documentation. You're pre-approved. This is great to have in your back pocket when you're going to look at homes so that if something comes up, you can move quickly. The pre-approval process lets you know exactly how much money you can borrow and tells the sellers that you're prepared to buy the home. Now, to obtain pre-approval, you'll need to assemble some financial records and fill out the application. You'll need to have at least pay stubs for the last 2 or 3 months. And you may have to provide that at the beginning and when you're ready to close your loan. Then you'll want W-2 forms for the last 2 years, your tax returns for the last 2 years, information about your assets and your debts, recent bank statements, and of course then any proof of additional income. Now, you do not need to disclose alimony or child support payments that you receive unless you want the lender to consider them as income available for you to use to repay the loan. Now, as Michael mentioned earlier, shopping around for a mortgage, it really does pay off. Now that you know the basics about mortgages, it's very important to shop around. Although almost half of all people who get mortgages don't. Shopping for a mortgage can save you money over the life of your loan. Get loan estimates from several different lenders, at least three. A loan estimate is a document that provides a lot of information, but very important details about the loan you asked about, including the APR, like Michael mentioned. That's the annual percentage rate. That's the cost of the loan over a year. Your real estate agent may suggest at least one lender, but also get written statements from at least two others. Ask other real estate professionals, your friends, your colleagues, your family members for recommendations for a mortgage lender. Also, don't forget your own financial institution. If you have a bank account somewhere and they do mortgages, don't forget to ask them. Then contact the lenders you're considering and tell them that you're ready to request a loan estimate. You don't need to provide written documentation yet. You generally can provide 6 key pieces of information to begin that application, including your name, your income, your social security number so that they can pull your credit, the address of the home you plan to purchase, an estimate of the home's value, typically the sale price, and the amount of loan that you're looking for. How much are you wanting to borrow? So this would be the price of the home minus your down payment amount. There is no fee for a loan estimate, although a lender may charge a fee for pulling your credit. So once you have those, make sure that you ask questions if you don't understand any of the information that they provide. So key takeaway for this section, know your loan. Learn about the different financing options for buying a home and shop around to get the best deal for you. So now we're going to talk about actually getting help and buying your loan. We're going to discuss how to put together a team of professionals to help you buy your home, the major steps to buying a home, and where to get help if you find you're struggling to make your payments on the mortgage after you've got the home. So get help. Get help with the home buying process. Interview before you hire and ask for references. Understand what services you will receive and how much they will cost. Now, it really does take a team. It takes a team of qualified people to help you buy your home. There are many professionals who can help and guide you in this process. One such professional is your real estate agent. They help you actually shop for and find your home that meets your needs and wants. There may be a whole team in addition to the real estate agent, such as an appraiser, your lender, an inspector, the title company, escrow, and of course, insurance. Now, a housing counselor provides you with education and counseling on the home buying process because it can be a bit overwhelming. The U.S. Department of Housing and Urban Development, HUD, approves housing counselors that can provide advice on buying a home. They provide assistance at any stage of the home buying process, and contacting them early may help you get connected to down payment assistance programs and other resources. So for that reason, it may be helpful to consult with a housing counselor before even reaching out to a lender. And you can find HUD certified housing counselors on HUD's website at www.hud.gov/find-a-counselor. You can just Google it, HUD housing counselor, and you will come up with a listing, but go to the HUD.gov website when you get those options. So who else might play a role in helping you find a home? The appraiser. The appraiser provides an estimate of the home's value. And you can learn more about appraisers and what they do by searching Understanding Residential Appraisals. Again, look for the .gov websites when you go there. Your lender, of course, qualifies you for a loan and lends you the money to help buy the home. Then you'll have a housing inspector. Now, the housing inspector and the appraisal are two different responsibilities. The home inspector identifies key problems with the home before you buy it. And we're going to talk about that in just a moment. Then some states require an attorney to help write the real estate contract. Now it goes through, when you go through escrow and your title company. So title company, your title insurance, researches the title of the property to make sure that the seller has the legal right to actually sell it, and make sure that it's free of any other liens. Then your insurance agent. So your insurance agent helps you to determine whether the property can even be insured and recommends how much insurance you might need and how much it will cost. Then making an offer. Now, this is the exciting part. This is the scary part. Making an offer on a home can be both complicated and very exciting. Once you find a home that you want to buy, you'll make an offer. This is when you tell the seller, I want to buy your home, and this is how much I'm willing to pay. Now, your real estate agent or your attorney will write the offer for you. So what's actually in an offer? Well, the address and description of the property, the sale price, how much money you're willing to pay, your target date for closing. Now, you may have heard of some escrows being short. There have been some escrows as short as 1 week, some as long as 6 months. Generally speaking, escrows run about 30 days, but that depends on both the buyer and the seller and their own situations. You might come to an agreement for a variety of terms. And then the amount of earnest money you're offering. This is the deposit that you will offer. So this goes towards into that escrow account that Michael spoke to earlier, goes into the escrow account. This is your earnest money deposit. I'm honest, I'm serious, I want to buy your home. This is my security. Put as little as possible in, because if you cancel, you may risk losing that deposit. Okay. What else is in an offer? Well, now you're going to talk about who pays for what. Who's going to pay for the title insurance? Who's going to pay for the termite inspection and the property surveys? Is it going to be the buyer or the seller as part of your negotiation? Then you may want to have a walkthrough clause, and that states that you have the right to walk through the property one more time before the sale is finalized. This is generally preferred after the seller has moved out, but right before closing. Say there's a beautiful chandelier in the dining room and you're so excited to have that in your home, but at final walkthrough, you walk through and you find the chandelier is gone, the seller has taken it with them. Well, was that in your offer? Was that in your agreement? So you want that final walkthrough to make sure that things are as they should be. Then in that offer is the date that your offer expires. So if the seller wishes to accept your offer, they must do so before this date, so that if they deny it, then you have the opportunity to go out and make other offers. Now, contingencies are statements that must be true or the offer is void. Now, this could include you getting financing. Your contract is contingent on your getting approved for the loan amount and the results of the inspection. So the home inspection, we're going to talk about that in just a moment, but if the home inspection identifies that there are issues maybe with plumbing or there's a crack in the ceiling, you want the seller to fix it before you buy it, those may be contingencies. Then special requests. For example, the buyer could request that all of the appliances be included in the home purchase, and any other terms that may be required by law in your state or that you and your real estate agent think are important to your offer. So now you've made the offer. On the next slide, in response, right? So now you and your real estate agent work together to put together the offer. You've submitted it. Now what? Well, a couple of different scenarios. Your seller could accept your offer and all negotiations end. Your offer plus the seller's acceptance now has become a legally binding contract. Or the seller could reject your offer, but make a counter offer back to you. You can walk away from the transaction at this time. There is no legally binding contract, or you can accept or reject the counter offer. You could also counter offer back. So if the seller rejects your offer and does not make a counter offer back to you, you can walk away. Again, there's no legally binding contract, or you could present a new offer to the seller and the process starts over again. So you can see how this can become complicated pretty quickly, which is why it's so important to have professionals help you through this process. If the seller accepts your offer and or you accept a counter offer, then you move forward with the financing and closing process. On the next slide then, you'll see I mentioned earlier the importance of the home inspection. Again, remember that this is separate from the appraisal. I would encourage anyone to consider strongly including a requirement in your offer that says it depends on the results of a home inspection. This is a type of contingency, and this means that your offer is contingent or depends on getting the results of the home inspection and you deciding at that point if you're still interested in purchasing the home. Like I said, it is not an appraisal. The appraisal is intended to provide the lender an estimated value of the home, which they use in determining how much they might be willing to lend for that property. The home inspection gives you detailed information about the condition of the home before buying it. This is one of the most important steps in protecting you and your investment in the home buying process. Because significant issues with the property may not be obvious. It may not be apparent without a home inspection. I don't know about you, but I'm not a plumbing expert. I'm not an electrician. There are a number of things. I'm not a foundation expert. So you want somebody who has that type of expertise. And while you can get recommendations for a home inspector from your real estate agent, make sure you're getting someone who will put your best interests first, not those of the real estate agent. In a home inspection, the qualified inspector takes an in-depth, unbiased look at your potential new home to evaluate the physical condition, structure, construction, mechanical systems, and they will help identify things that need to be repaired or replaced. They will estimate the remaining useful life of major systems, equipment, structures, and finishes. In some cases, you may even need a secondary inspection. For example, if the property you wish to purchase has an unusual heating or cooling system, or if it has well water, you may need to have someone who has specific skill sets in those areas. If there could be foundation issues, you may need to consult a structural engineer. So bear in mind how important the home inspection is. And in markets where homes are selling very quickly, some buyers may decide to waive a home inspection. They may be willing to take the risk in buying a house that has potentially unknown needed repair. It's your decision. Either way, you should know your rights and what you're giving up if you choose not to engage in a home inspection. So documents at closing. So you've gone through the offer, you've been accepted, you've gone through escrow, you've had the appraisal, you've had the home inspection. All right, now you're moving along. Now you can expect to get a lot of documents, a lot. not the least of which will include your loan estimate. So this lays out the information about your loan. You will have already seen this in most circumstances at the beginning. Then your closing disclosure. This is the form that lists the final terms of your loans, the final closing costs, and the details of who pays and who receives what monies, including your appraisal, your title insurance, all of that. Your initial escrow statement. This lists the cost the lender expects to pay from your escrow account. That includes your taxes and your insurance premiums. Okay. Then your promissory note. The promissory note is the document that details your loans, the amount of money that you borrowed and have to pay back, the interest rate, the dates, the term or length of your loan, the total amount of money you will pay over the life of the loan, and whether and how payment amounts can change and where to send those payments. Then you'll have payment option information, whether you want to have it automatically deducted from your bank account, and then a mortgage or security instrument. This explains your rights and responsibilities as a borrower. The mortgage grants the lender or servicer the right to foreclose on your home if you fail to make payments as agreed. You will not always receive a notice of the right to rescind, because once the loan closes, you do not have the right to cancel. However, you will receive this notice if you are refinancing a mortgage under certain circumstances. And then there may be other documents required by state law. Now, closing on a home, the very last step. You're almost there, right? Closing is the last step in the home buying process. All things have settled. At closing, the loan becomes final. The funds are distributed out to the seller and the other professionals who receive payment at closing. And this is when you become the owner of the home. It's time to celebrate. A title to the property gives you the right to use and sell the property. Excuse me. The deed or deed of trust is the actual legal document that transfers the title to you and is recorded with the county. Excuse me. All right. Now, once you have the home, congratulations. All right. On the next slide then, getting help when you're in trouble. We know life happens. Once you have your home, it's important to get help if you're unable to make those mortgage payments. It could be a result of a one-time issue, an unexpected expenses, or a long-term issue, job loss. As soon as you realize that you're going to have any kind of trouble making your payments on time, don't wait. The number one mistake people make is waiting too long to get help. Contact your lender before your payment is due, before your payment goes delinquent. They may be able to offer you a loan modification to help you through that. There are home preservation hotlines, the HUD approved housing counseling agency, or your state housing finance agency. So remember then on the next slide, we'll see the takeaway for this section. Get help with the home buying process. It's complicated. It can be. Interview before you actually hire the person. Make sure that you are comfortable and ask for references and understand what services you will receive and how much they will cost. And with this, I will turn it over to Mary Duran from the FDIC.
Thank you, Cheryl and Michael, for a wonderful presentation. And I just want to share a couple of tools and ideas to our participants today. And one of them is called LA Saves. It's an initiative to try to think small, think big, start small, think big, and set a goal. And the website's lasaves.org. Next slide, which is part of America Saves, which is an initiative of a national nonprofit organization called Consumer Federation of America, which seeks to motivate and encourage people to save money, reduce their debt, and build wealth. And it's a research-based campaign using the principles of behavioral economics and social marketing to change behavior. Next. So why should you save? Well, I think today, in listening to the presentation on purchasing a home, you want to save for the down payment. And you can work towards saving by taking a pledge to save and start that process of accumulating your down payment. So it's simple. Next slide. To take the pledge, you just need to go to the website at lasaves.org, enter your name, set a goal, for example, to purchase a home for the down payment, make a plan. How much do you want to save each month and for how many months? And then, Cheryl, and then your email address, your phone number, and zip code. I'm not sure what happened here. Next slide. This is what it looks like. Next slide. If you don't already have a bank account, it's important to get one because you'll need it for the process in applying for a home. They're going to want to see that your money is in the bank. Next slide. There are a number of banks that provide affordable entry-level accounts, and there's a bank on Los Angeles County that's supported by the county, and you can find banks that offer low-cost accounts. And the website to do so, or you can Google Bank on Los Angeles County. Next slide. I also want to share with you, if you want to get additional financial education information, the FDIC has this great game, How Many Smart Are You?, that you can play on your own and research additional topics related to financial education. Next slide. So finally, I want to say, take action. What are you going to do with the information that you received today? How will you do it? And will you share your plans with anyone? We suggest that you do share your plan because it's like when you think I'm going to lose 5 pounds and you just think about it, it may not happen. But if you tell your best friend, she's going to make sure that you keep to it. And that's the whole idea behind taking a pledge, taking action on what you learned today, is set a plan of how you're going to get to the process of being able to purchase a home. Next slide. I do want to leave you with some additional resources of how to obtain your credit card, how to find a HUD-approved counselor, some counseling preservation hotline. The Consumer Financial Protection Bureau has a lot of information related to this whole process. Encourage you to take the LA Saves Pledge and start saving for your down payment, and then learn how to establish a bank account. The FDIC has information on our website as well. And that brings us to our last slide, in which I want to thank Cheryl and Michael for their presentation and turn it back to Caroline to see if we have any questions.
I guess I'm muted. Thank you, everyone, for a great presentation. So let's get to the questions, and let's see. Okay, so we have a question from Raw. He's looking to become a first-time homeowner with a VA loan. And, well, he has a two-parter. So for the VA loan, how do you, I guess, where would you go first to do that?
I guess I'll take that one. All right. Rod, thank you for your question. So not all lenders are VA lenders. So you will want to identify your lender. You can go through the Veterans Association or the Veterans Administration. You can also maybe Google more VA loans and identify a lender through that. Also, as we talked about with the HUD certified housing counselors, I think that's a really great first step for anyone looking to buy a home that's not familiar with the process already. A number of those HUD certified housing counselors have relationships with a number of lenders. and can identify those lenders that they've worked with previously with their home buyers. And most these HUD certified housing counselors, they're nonprofit. They get nothing out of this. They don't get a referral fee, so they really are working in your best interest. So that might be a great first step, is to contact a HUD certified housing counselor, and or on your own identify a lender that is a VA lender, and then just pick up the phone or send them an email and have a conversation with them.
Okay. Thank you very much, Cheryl. And then the second part, we'll get another one. Seems like buying a foreclosure may be a better deal.
That may or may not be true.
Yeah.
Bear in mind, when we were looking at the housing crisis back in 2008, 9, 10, 11, 12, there were a lot of great deals out there. Bear in mind, though, that when you're looking at a foreclosure, there may be other issues with the home. Oftentimes foreclosures are fixer-uppers and they're sold as is. And I don't know if you saw the movie Money Pit, but sometimes you don't know what you're getting into until you're in it. And it can be a bit overwhelming. Although that's not to say that there aren't still some great deals out there in the foreclosure market. But it's a very highly competitive marketplace to look at.
Thank you, Cheryl. Ross says thank you. Thank you. I think we might have time for like maybe one more question. So basically, let me see if I have, because I had a few questions too, but I'm going to ask one. How can a home loan counselor help me through the whole process of buying a home?
Michael, you want to take that one?
Sure. So generally, they're familiar with the complete home buying process. So they're there to really serve as a guide to answer any questions that you may have or anticipate have during the home buying process. It could be related to just general terms and understanding the terms of a loan. They're there to assist and help you understand that, or it may be related to the closing process. How long will it take my loan to close? Where will I close? Do I need I don't know, what will I need to bring to closing? And so even though generally throughout the loan process, those that are involved, such as the title company, will tell you certain information. Again, you may want to validate or verify through another source. And so again, your loan counselor is a good source to and then ask questions. And so if it's, I'm going to closing and they tell me I need this amount. How do I get it to them? Do I wire it to them? Do I bring a cashier's check, etc.? So, and I'm really just there to answer any questions. Or I'm searching for homeowners insurance. I'm having a hard time finding insurance at an affordable rate. Do you have any recommendations as far as resources, kind of where I can go to find or shop around for insurance? They can probably provide you maybe the state's Department of Insurance, who may be able to guide you into the right direction. So I would just say use them as a resource.
Great, thank you.
Caroline,
yes, Mary, go ahead.
Caroline, if I could add, they're also very useful in that beginning process to help you figure out how much of a house can you buy. They'll help you with the calculations. They'll, when you pull your credit report, you may not know how to read it or what does it mean. And they can really be good at going through it. Maybe there's some stuff that's not yours. They can help you clean it up. Maybe there's some stuff that is yours, and they could give you some advice as to how to improve your credit so that you could qualify. So they're really good partners, and starting at the beginning with their assistance and then going through, as Michael says, they continue to be helpful when you're trying to understand through the process or you have additional questions. They're a really great source to assist you.
Thank you, Mary. I actually didn't know about these home loan counselors, honestly, when I was buying. Well, I mean, my husband's kind of in the industry, but I didn't really know about, there's such a thing as a home loan counselor, but that's so great that people can go to HUD and get help with, because it's such a complicated, long process. So, any help that's provided, it's very important. So thank you guys again, and we're at time. So I'm going to just close the presentation. So thank you again. If anyone missed any part of this presentation, it will be available for viewing on LAPL's YouTube channel. at youtube.com/Los Angeles Library. It should be available shortly. And also, we have a Spanish language version of this presentation. It's next Tuesday, June 20th at 12 p.m. And for more information on the Spanish language version or for any of our library programs, you can go to our library calendar online at lepl.org/what's-on/calendar. Thank you all again and have a great rest of your day. Thank you, everyone. Bye-bye.
Thank you.
Bye-bye.